my fun, cocktail party nugget is that for the Treasury market, we had the worst drawdown in U.S. Treasuries since Alexander Hamilton was Treasury Secretary in 1791, when we were at risk of defaulting on the debts we accumulated during the Revolutionary War, trying to pay off the French and others. That's how bad last year was as someone invested in high-grade Treasury, U.S. Treasury bonds.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Joining me today, and I will say back by popular demand, even if it's just my demand that's popular, David Mitchell, Director of AllianceBernstein. We're going to review predictions or forecasts that David made 2 years ago, March of 2021. We're going to look at where those forecasts are today. We're going to revisit where we stand today with inflation and bank failures and all the other crazy things that are going on. And we're going to take a look forward of what you can expect for the capital markets, not just this year, but in the next decade. Please enjoy my conversation with David Mitchell. Before we hop into today's episode, I want to remind our listeners and viewers that you can access the same financial planning tools we use for our own clients on your own time, and all from the comfort of your own home. All you need to do is visit the link in the show notes and click the Start Planning button. From there, you can start building your retirement plan, no cost, no obligation. All right, back in studio again, David Mitchell, Director with AllianceBernstein. Good to have you back.
My pleasure, Dean. Always good to see you.
It's been 2 years. We are sitting here on the 29th day of March here, 2023, as we produce this podcast. The last time that we did a podcast, it was actually episode 43 of the Guided Retirement Show in March of 2021. So I want to start off by taking a little trip back in time to March of 2021. We were in the throes of the most rip-roaring bull run coming off of those COVID lows. One of the biggest, quickest runs that you and I have witnessed in our entire career. And yet you sat here and you said that the outlook from AllianceBernstein is around 5 to 5.5% per year on the S&P 500 for the next decade.
That's right.
Right?
Yep.
And by the end of 2021, people that were listening to that would have said, this David Mitchell guy, he doesn't know what he's talking about.
Market was up 26. I got paid, half of the next decades in the next 9 months.
Yeah. But we were also at 4,300 on the S&P when we did that podcast in 2021. Now we're at 4,000 on the S&P. So we're a negative 8% total return in 2 years.
Yeah.
Where's my 5%? Does that mean now I get to add 8 to 40? So now I can get 48% in the next 8 years? Is that what you're saying?
I would say this. I would say our forward return forecast 2 years later has gone up from that low 5 range.
So you got to be in the mid 6s now.
We're back in the mid 6s, maybe even high 6s now.
Okay.
We'll have our updated forecast here out in the next few weeks.
But it's because we had 2 years where we're negative over the 2 year period.
Well, and like you said, Dean, if your opening tells me a lot. One about just the behavioral finance side of stocks and investing, but had you invested in March of 2021 when we had that last conversation, and then you cryogenically freeze yourself, and you wake up and you're listening to this 2 years later, you'd be like, that guy was kind of neutral to maybe a little bearish, but he wasn't bearish enough. Versus if you listen to that a year later, or maybe at the end of 21 when the market was at 4,800, when the S&P was priced at 4,800, and we'd had this huge back-to-back year of 2020, 21 gains in stocks and really risk assets across the board, you would have been like, that guy was way too negative. So it's always one of these things that when people ask my opinion of the stock market or outlook, I always have to match that with time horizon and duration. Because over the short term, as you and I both know, markets become more irrational. the mathematical mechanisms can break down between the stock and bond market, especially the shorter time horizon you go. But that's why I force people to say, if I'm going to give you an outlook, you got to give me at least 2 to 3 years.
Sure. And you know, nobody anticipated how quickly Jerome Powell and the Federal Reserve were going to raise rates in 2022.
Correct. We did not.
I don't think anybody did.
Yeah.
Nobody did, right? So let's go back again to March of 2021. In March of 2021, you thought bonds might give you 2 to 3% over the next
closer
decade.
To, on AAA, like Treasury bonds, closer to 2%.
2% per year.
Yeah.
So you're talking about so if you had a 60-40 portfolio and you were 5 to 5.5 on the market and 2 to 2.5.
You were saying 4% for a balanced
total
portfolio,
return, right?
Yeah.
So now we run into 2022, the worst year in the bond market that I've seen in 36 years. I don't know of a year where the bond market was as horrific as what it was in 2022.
It's anywhere, depending upon which bond asset class you look at or which bond sector you look at.
I was just looking at the overall bond
So
aggregate.
some it had been since 1981, but my fun cocktail party nugget is that for the Treasury market, we had the worst drawdown in U.S. Treasuries since Alexander Hamilton was Treasury Secretary in 1791, when we were at risk of defaulting on the debts we accumulated during the Revolutionary War, trying to pay off the French and others. That's how bad last year was as someone invested in high-grade Treasury, U.S. Treasury bonds.
Well, we saw the yield on the 10-year go from 1.1 to 4%. And so, you'd think about that, the correlation between interest rates and the value of bonds. And as interest rates are rising, the value of those bonds are falling. Now, obviously, you hold it to maturity, you're going to get your money back, but
Correct.
you're still just going to get the coupon over time, right?
Right. Yeah, you had locked in if you bought the 10-year Treasury at 1, and your intention was to hold it to maturity. Debatable about how many people or institutions actually do that. You weren't going to lose money, but you just guaranteed a very low return,
1%,
much less than that of what inflation ended up being, right? So your real return, your net return after inflation, what we call real return, was well negative.
Okay, so as we sit here, end of March 2023, what is AllianceBernstein's outlook for the broad bond aggregate for the next decade now?
The thing I love about bonds, the math is a bit more certain than it is with stocks. There's less forecasting, less modeling involved because 90% of a bond's return is its cash flow. So if we look right now, if you look at the kind of the global ag or the U.S. ag, which is mostly high grade treasuries, investment grade corporates, right? Very high quality index. The yield to maturity on that is again in the mid 3s.
Okay.
So 3.5% ish. So for over the next, call it in the duration on that's around 6-7 years. So if you were to hold that for the next, call it 6 years, you'd annualize about a 3.5% return.
All right. So we've gone up to where we sit today, potential for 3.5% in the bond ag, 6.5% in the market. Mm-hmm. So now we're 60-40 portfolio puts us at 5.25 to 5.5.
Yeah. And here's why that's so important. Versus, because you heard me say 2 years ago, we were saying maybe 4% on a balanced portfolio.
Right.
Now we're saying, hey, 5%, maybe a little more. So, but let's just say the difference was 1%. To your average listener, they might hear that and say, what's 1% a year? Is that really that much difference? But here's a stat that I read in some research AllianceBernstein did almost 15 years ago, studying longevity risk, the risk of people outliving their money in retirement. As scientific innovation was happening, people were living longer. We had to basically, as an industry, check ourselves to ensure that we had people invested the correct way to sustain 35, 30-year retirements, people living to be 92, 93 years old.
Right.
If you so during your accumulation years, which we define as from 25 to 65, if you just add 1% incremental return a year, again, a balanced portfolio, 4% to 5%, I'll ask you, how much extra spending power, how many extra years do you think that equates to in your spending?
Another 10 to 12, probably. 10, yeah.
another decade of so people hear 1% a year. What does that really get me? Over again, long periods of time, an extra 10 years of spending power in your financial plan.
All right, let's back up to go. Let's kind of shorten the time horizon here a little bit because we've kind of looked at what did AllianceBernstein think the long-term average was in 2021. What do we think it is today? We've had something happen over the last 12 months, a lot of somethings.
Did you have the largest land war in Europe on your business card?
I did not.
Since World War II?
I did not.
On your bingo card.
I did not. Nor did I have our Fed funds rate between 4.75% and 5%. Right. Nor did I have one of the largest banks in the U.S. failing and needing to be bailed out, and then another one right behind it, and then issues with Credit Suisse. A lot of things have happened, and many people believe that, first of all, the Fed was late to start raising rates because they thought that inflation was transitory, that the Fed should have started raising rates back in 2021, done it more methodically, and that now they got so far behind the eight ball that they have gone too far. And because they've gone too far, we have an inverted yield curve that you and I have not ever seen. We have an inverted yield curve from the 6-month to the 10-year of 1.4%. Yeah. So in other words, I get a 1.4% greater yield on the 6-month Treasury than I can on the 10-year Treasury today. Right. That's the most inverted yield curve that I've ever seen.
Yeah, we've seen inversions, just not to this extent.
Not to this extent. Yeah. And those inversions tell us that a recession is very, very likely in the coming months. Now, whether that's 3 months, 6 months, 9 months, 12 months, 18 months, we don't know. But if we have a recession, first of all, let me ask you a question. Do you think there is a recession on the horizon?
I do.
Okay.
Now, I think what's first important to do, because when you say recession, that means a lot of different things to a lot of different people. I'm talking about a labor market recession. So when I say recession, what we would need to see to define a recession is actually net job loss and the unemployment rate rising.
Which is what Powell wants to happen.
Yes.
He wants to kill jobs.
Correct.
Right? Because the consumer is 70% of our total GDP, and as long as the consumer remains resilient and strong, he's going to have a really hard time bringing down inflation.
Bringing down inflation quickly, yes.
Yes. Yeah. So so do you think we'll actually see negative GDP growth, or do you just think it'll be net job losses in the labor market?
So recall, just go back to last year, 2022. We briefly did see negative GDP. Now there were some goofy accounting issues with it. So I don't consider we had an actual recession, because a lot of people say, Dave, the textbook definition of a recession is 2 consecutive quarters of negative GDP, which we had barely last year, but we think that there's an asterisk next to that in the history books.
Right.
So to answer your question, Dean, do I think we see actually a labor market recession, which, just to give you some numbers behind it, we're at about 3.6 unemployment rate today, one of the lowest levels it's been in 60 years. If we went to 4.6, 4.7, which is where the Fed's sort of model is showing we need to get to bring inflation down to a more comfortable level for them, that's about 1.3 million jobs. Do I think that's going to happen? I would put the odds on greater than 50%. Now, the timing of it, I don't know. Is it by the end of this year? I don't think so. Is it by the end of 24? I would think so.
All right. So if we have a labor recession, and if we have negative GDP growth, that obviously affects the long-term or the forward-looking earnings for corporate America. So you and I were talking prior to starting the podcast here today that you have lowered your earnings forecast for the broad market, the S&P 500, for the calendar year 2024. So tell us, where did you start? Where did you think earnings were going to be on a per share basis? And then where do you think they're going to be now?
So just as a comparison to what we call the street, or the average sort of analyst out there amongst the large investment firms, because every paid analyst has to give a year-end forecast for what they think earnings per share in dollars will be at for a given year. The average analyst came in January 1st of this year and was about $228 per share. AllianceBernstein at that time We thought that was a bit too optimistic for a variety of reasons. But we had it we had about $10 lower, about between 215 and 220, let's call it 218. And we thought the street, i.e. the analyst community, would come down to meet our expectations, which, as I shared with you, Dean, every single week on average, about $1 of earnings has come out. So right now, as of today, sitting here in mid-March, we're closer to that 218, 220 number where we started the year.
So if we end the year with that being the earnings per share, what does that do to the valuation of the S&P 500 from where we started? Where does that put it? If we could say that markets are rational, and which we can't, of course.
I'll give you an exact number.
Okay, so if we can say that markets are rational and they're going to be priced fairly, if we have earnings at that level, that 218, where does that put the S&P 500?
So let's just say we're in and around 17, 18 times multiple. So and this would assume the Fed, if they start to loosen policy or cut, they don't cut aggressively, maybe once or twice by the end of the year, but not to really meaningfully change what we call the discount rate or the policy rate. That would put us probably in an S&P range on the low side of 3650, on the high side to 3960.
Okay, so we're at
4,000
today.
So a little downside.
So you're saying there's the potential to go down 10% from here, but there's also the potential that we wind up the year about where we are right now, or a little less.
And again, the other case would be even higher if the slowdown is, we kind of again hit this sweet spot where inflation's coming down. There's some job loss, but not enough to really take down corporate profits, maybe much below 220. And then the market re-rates, puts a higher multiple because the 10-year treasury and other yields are coming down. So you're discounting those future cash flows at a lower rate, which just gets wonky. But that's how, because people ask me, Dave, how do you get to 42 or 4,300 on the S&P, maybe back to where we were in March of 21? That's how you would get there.
So you need a lower terminal rate or a lower rate from the Fed in order to get there if earnings remain where they are.
That's correct.
Now, do you think that earnings can remain there, or do you think that there's too much softening in the economy because the Fed went too far, that that forecasted earning for the S&P 500 is actually going to come in lower?
I think the problem for the market, Dean, in the very short term, and why we're, again, neutral to slightly underweight equities, we're much more bullish on fixed income. I know we're going to talk about bonds. I just don't think those things match up. I don't think that you could have earnings holding at a reasonable level, I'll call it $220, basically where the market's at today, the street's at today, and the Fed also cut policy at the same time. I think the only way Powell, given his rhetoric so far, and his desire to be Paul Volcker incarnate and really slay inflation, get it back to keep saying 2%. He's saying there's no new normal of 3%. I want it back at 2%. I just don't know how he could aggressively pivot and become more dovish unless equities and the economy fall off a cliff. I think that's the only way you're going to see him really pivot. Because, by the way, you mentioned they made two mistakes and they kept rates too low for too long during 21.
Right.
And are they going a bit too far here? I could actually take you back to 2019.
Oh, yeah.
Remember when he blinked and started cutting? You know, the market was down 20% at the end of 2018, peak to trough, and then Powell pivoted. And we had a huge run up in asset prices and valuations in 2019 because, again, of the great Fed pivot of early 2019. So I could argue this is kind of strike three.
Okay, so let's talk about this Fed pivot, but I want to go instead. Let's call it the Fed put. So since 2008, since the Great Recession, investors in equity markets have counted on the Fed to backstop market and economic turmoil. And in 2022, the Fed turned its back on the market and the Fed turned its back on economic turmoil. So the Fed put was basically removed.
Right.
And now all of a sudden the Fed was fighting against every single thing that they had been helping to support and prop up for 15 years. Yeah. So you don't think that Powell goes back to that? I mean,
I think the economy would have to really roll over, meaningfully deteriorate, and I think as such, corporate earnings would have to come down from 220. Maybe there, as you know, Dean, you follow this as close as I do. There are bearish strategists on the street at certain firms that are saying earnings per share at $200 or less. So, a 10, 15, 20% downside from here.
Right, and that puts us back around 3,200.
If that were to manifest, then I do think Powell would blink and start to ease again.
Right. Well, let's hope that doesn't happen.
Yeah, because for a variety of reasons, because I think the pain in getting there would be a meaningful drawdown in equity markets. And granted, I think if Powell pivoted, you might see some stability. But again, how long until those earnings recover? That would be the question.
Right. So two things I want to cover here. I want to get to fixed income, but I don't want to end our podcast without talking about how you navigate through a market that is forecasting 6.5% over the next decade per year. Because I know that that's the broad market, right? But there's pockets of opportunity within that market if you are more strategic or tactical and you're going after those opportunities as opposed to just you're indexing and you're buying a broad index.
That's right.
So your 6.5 is the broad index.
That's the broad index, correct.
That's not, I don't think that's your target for what you all would like to achieve over the next decade.
No,
right?
if our stock pickers that work at AllianceBernstein, if there's any past is precedent, our best ones have been able to outperform their given benchmark by 1.5 to 2.5% a year, going back to that just even 1% a year over time.
So now we get to 8 to 9.
There you go, back to basically long-term averages,
right?
Going back to the last 100 years.
But you don't believe that is in the cards for just an indexer?
No, I don't.
You got to be more. You got to be in the right spot.
You do,
because not everything's gonna go up.
And it's not so much, Dean. It goes both ways, right? It's not just about what companies you own, but in a period of volatility, in a period of earnings deceleration, like we're going to see, it's also about what you avoid. If you just buy an index, you're beholden to own everything,
right?
Versus if you're just buying the 30 or 40 best ideas of a subset of stocks. Yes, you hopefully own a lot of great companies, but at the same time, you're avoiding 400 or 500 or 1,000 companies that you don't want to own for legitimate reasons.
Well, and that's all about your focused, way that you guys manage money.
That's correct. Yeah.
Because, you look at the indexes where we are here at the end of March, you got the Dow negative, you got the S&P positive by about 4.5%, you got the Russell 3000 positive by a couple percent, and then you got the NASDAQ, which got killed in 2022, up about
now leading
14 or 15 this year.
Yep.
Yeah. So, all right. So, suffice to say, if we want to do better than the overall market, we have to have active management.
I would say, to your point earlier, I think for both stocks and bonds.
Okay, so let's switch gears to bonds, because you said you were slightly more negative than positive on stocks, but you're actually more positive on bonds. And I think that might catch a few people by surprise, coming off of the worst year that the bond market has had since, what'd you say, Alexander Hamilton?
Yeah, for treasuries, since Alexander Hamilton, others 1980. But this goes to the notion of, Dean, it's how we tend to shop for everything else in our life when things are on sale or low. Bonds are the same way. If we're coming off, and if bonds are mathematical instruments, and the only way that what I love about bonds, and why my heart is always kind of with the bond market, the only way you permanently lose money in bonds or impair capital is if the issuer of the bond that you own goes bankrupt or defaults.
Right.
Again, interest rate fluctuations are optics. At maturity, as long as
you know what you're going to get.
You know what you're going to get. The math is the math is the math.
Right.
And so that's why when I look at a diversified portfolio today, I said a very high grade portfolio is going to get you 3.5%. But if I start to sprinkle in some more, some borderline investment grade, maybe a little high yield that's attractive, I can get you to a 6% starting yield. So this pound for pound, what would you rather have? An investor who owns the SPY, the S&P 500, one of the largest indexes in the world of the 500 stocks in the S&P 500, which I'm telling you here, that looks better, but I think it's still going to only get you maybe 6%. Right? with all the variability around earnings, multiples, versus I know I can build you a bond portfolio today with the starting yield of 6, same return, but with more certainty in getting that return and a lot less risk.
I'm going to go with, especially people that are sitting in retirement or heading towards retirement, they want that 6%. They want the bond. But people are scared to death of bonds today because of what happened. Yeah, I mean,
it's recency bias. Going back to, we always talk a lot about behavioral, finance and sciences. I'm a big Daniel Kahneman advocate. This goes into what he calls anchoring or recency bias, right? When you're coming off of the worst market for anything ever, that doesn't make it feel great to buy low. It's like the old marketing or advertisement of the kid eating their vegetables, and there was a sign that someone, I forget who the firm was, but said, "This is what it feels like to buy low." The kid forcing to eat his vegetables, right?
Sounds about right. Sounds about right. So if what you're saying is, let me just recap. You're saying that we can build a decent bond portfolio, fairly high quality across the board with yields around 6. We can do the right type of stock picking, potentially get to 8 to 9%. Now all of a sudden our next 10-year average with a 60-40 portfolio like that is around 7 to 7.5.
There you go.
Which is where a person really needs to be in order to take that 4 or 5% distribution rate during retirement and still be able to keep up with inflation.
That's right. That's where we need to be. Especially if you're still withdrawing 4 or above. Yes.
We're going to do this again, and we're going to go back and, just like we did today, go back and say, here's what we were talking about a year ago or 2 years ago. We'll do it sooner, though. We'll do it. Okay. We'll do it in a year. And if something else pressing comes up, I'll have you back on and we'll do some more on that. But I think it's fascinating to look at what we were talking about 2 years ago, where we are today. And I think really the future forecast is still the same. It's just that we're at lower price points today from where the markets are now, where bonds are priced at today. So we can get a little bit better, but by being more tactical, more strategic, as opposed to just owning the indexes, you believe that 7 to 7.5% long-term average on the 60-40 portfolio is possible over the next decade?
I think it's still in the cards. Again, to your point, you just have to, it's going to be much harder to construct and to achieve. And it's going to take every ounce of your portfolio being positioned the correct way to do it.
Fascinating. It's always fun to have you on to talk about this, David. I mean, you and I can. I want everybody to just imagine for just a minute that David and I are out playing golf and what the conversation's like on the golf course. We actually
there might be a few expletives in there, as some after a couple tee shots, but yes, a lot of it's similar.
It is. Well, I appreciate you being here on the Guided Retirement Show.
My pleasure, Dean. Thank you.
Thanks again for joining me with my conversation with David Mitchell here on the Guided Retirement Show. If you missed episode 43, go back and listen to that, and you'll hear the full conversation of the forecast that he made 2 years ago. So we talked about a lot. Let me just sum it up for you here. The indexing that is so popular may not be the best approach for the coming decade. You may need to get a lot more strategic and a lot more tactical in order to deliver the types of long-term results that you want to see in your portfolio. Don't forget, we're offering you access to the same financial planning tools we use for our own clients. Just get out to the link in the show notes and click the Start Planning button and begin your retirement plan from the comfort of your own home.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Barber Financial Group and SEC registered investment advisor.